The insurance business has some of the best cash-heavy, predictable revenue-generating compounders on the stock market. And it's one of the primary reasons Warren Buffett's Berkshire Hathaway compounded the way it did under his leadership. Welcome to part 1 in a 2-part series of where I evaluate and grade 16 different insurance stocks. In this video, we'll be going over 7 of those 16, and I'll explain the metrics that we use to see if it's high quality or not. Without further ado, the first company that we're going to be covering is Prudential Financial, ticker symbol PRU, currently trading for about $107 a share. And what's interesting about Prudential is that they don't just do insurance. They also do mutual funds and retirement planning. So they have a pretty diversified revenue model, no heavy assets or physical products. Everything that they do is in the finance realm. Their current net income per share is $6.33. Their dividend profile, I would argue, is pretty darn good. A 5% dividend yield, the payout is $5.40, and the growth rate is just in line with what we want, slightly above the rate of historical inflation, 3.9%. Pretty good. But here's what is not so good. When we take a look at their total return, broken down on a year-over-year basis, 5.8%. Between you and me, I think that's straight doo-doo. You would do far better just investing into a dividend ETF like SEHD. And when we take a look at their tangible book value per share, by the way, every single one of these metrics right here, we're going to go over with the next company, because the next one I'm a little more excited about. This one, not as much. But in the context of Prudential Financial, $84.41, not bad. However, what I do like is that they're growing this value right here, year over year, at a rate of 15%. That is pretty juicy. Double-digit rate? Actually, that's spectacular. But unfortunately, the return on equity, the ROE, just average. A little less than 8%, 7.9% to be exact. Nothing to write home about. And I wanted to start out this video with what an average-looking insurance business would look like, and that's why we picked Prudential Financial. I think everything taken into account and consideration, their overall grade in comparison to all 16 insurance stocks is a C-. And by the way, remember how we talked about the float, the money the insurance company collects and pulls and grows upon itself? Well, let me show you where to look for that on the balance sheet. So we're stepping on over Prudential Financial's balance sheet. It's under right here, total investments. So their float is $447 billion of cash and cash equivalents. Not this one. This is just the accounting cash and cash equivalents of $16 billion. This is their insurance float, the University Endowment Fund. And the reason why I'm showing you this is because you want to see, in a perfect world, this float be increasing year over year. But that is not the case with Prudential Financial. As a matter of fact, 2015, they had $416 billion in their float. It reached a high in 2020 of $552 billion. But since 2020, dude, it's just been declining and pretty much flat. Ideally, this number should have grown to where in the trailing 12 months, it should be at least $600 billion, but it went in the other direction. So that's something else that's weighing against Prudential Financial. And I think overall, it's just an average, okay stock, especially in the insurance world. Now, the next insurance business that we're going to talk about, Travelers Companies, ticker symbol TRV. Now, this one is above average. It's a typical insurance company. It does your auto insurance, homeowners insurance, landlord insurance, and of course, travel insurance. When you go travel abroad, when you go take your annual vacation to Bangkok, Thailand, of course you want to be insured just in case anything happens. They do a lot more than that, but it's their bread and butter. They basically do insurance for every industry and style. Now, as we take a look at their numbers, currently trading for about $256, might be a little higher, a little lower, depending on when you watch this video. Their earnings per share, which is their profitability per share, is $18.38. Pretty solid. And taking a look at their dividend profile, nothing too crazy. I think it's just okay. A 1.7% dividend yield, not the greatest. But what is really great is their strong CAGR performance. 12.2% year over year for the past 20 years. Friends and family, by definition, this is a dividend compounder with cheese. Absolutely beautiful. And now I wanted to take this time to explain the metrics from here all the way down to here. Their first one is going to be the tangible book value per share. When you think about it, insurance is a balance sheet driven business because they invest the float. So the book value, their balance sheet, what they have on the books is really important, and you want to see it be growing year over year. In other words, the book value is how much the company is worth on the books, how much financial assets that they have. Now, for most insurance stocks, we use the tangible book value. However, for Berkshire Hathaway, they're a little unique because they have other business sectors in their portfolio, like a railroad company, Dairy Queen, and Brooks Running Shoes. So for them, we'll just use the book value. But for every other insurance business that only does insurance and or financials, we use the tangible book value because it shows us how much real hard capital is backing the business. And in the case of Travelers companies, they're growing their book value per share at a rate of 14.9% year over year, which I would argue is pretty darn phenomenal. And the next thing is the price to earnings, the PE, the trading multiple. I think everybody under the sun understands what this number is, how expensive a company is in relation to their earnings. You essentially take the market price at $256 and you divide it by the earnings per share of $18.38. However, for me, I plugged in the forward trading multiple. So the PE ratio that's anticipated next year, which means it's the PE ratio based on next year's EPS. We're dividing by next year's EPS because we want to be forward looking, not looking at the past, but what will they achieve? And as we jump down to the next row, the price to book ratio, the PB ratio, is basically how expensive the stock price is in relation to their tangible book value per share. Now, in a perfect world, you do want to see this number be bigger than this number, because usually what that means is the sentiment for this company is bullish. The higher this number, the higher the expectations. It's kind of like Nvidia or any other AI stock having a trading multiple of like a 50, a PE ratio of like a 50, high expectations. So the higher this number, the higher the expectations. The closer it is to 1, the lower the expectations, like a lower PE ratio. They don't expect much growth or much from you. But that's just a loose rule of nipple, because you also need to take into account the return on equity, the ROE. You need to look at this one, and this one all together, those three, the trifecta, in a combination format to really reach a conclusion about the valuation of an insurance business. You can't really just look at this by itself, or the return on equity by itself. They work together. Now, the return on equity is basically what it sounds like. It's the net income, the bottom line, divided by the shareholders' equity. So the bigger the profits or the bottom line, like the bigger the net income, then the bigger the ROE. The smaller the net income, the smaller the return on equity. So how effectively is the company generating profit from the money that the shareholders have invested, from buying into the company stocks and the retained earnings, which is the accumulated net income? By the way, watch my video that I made talking about how to read and analyze a balance sheet like an investor, because we go over that. And for the ROE, the golden standard is at least 10%. If it's 10%, that's good. If it's like 15%, that's juicy. So Travelers company, 16%, pretty darn good. Anything above 20%, and that's bonkers. That is really freaking excellent. Now, let me just play out some examples. If the PE ratio is low, like it is for Prudential Financial 7.8, and the ROE is also low, and the price to book ratio is around 1, that means the insurance company is struggling. They have poor underwriting, they have underpriced their risk, they're taking on too much customers that are just high risk profile, and they just have issues with profitability. But on the other side of the argument, let's say a company had a PE ratio of a 7.8 and their price to book ratio was 1.2, but the return on equity was Travelers companies of a 16%. That means that insurance company is undervalued and it's high quality. So you use those three metrics together to figure out whether or not this insurance business is good. If the ROE is double digits, you already know, okay, that's good, but is the valuation good or are they overpriced? The PE ratio and the price to book ratio tells you whether or not there's high expectations for this company and if they're cheap or not. So if this number is low, like a 1, and this number is high, like 16%, is good. But in the case of Travelers companies, I think they're fairly valued right now. And as you'll see from the other insurance businesses that we're going to analyze, usually if this number is big, then this number is going to be big as well. However, there are some hidden gems that we are going to cover where the ROE is super high, but the price to book ratio is really low. And also their PE ratio is low, which means what? Undervalued. Now, taking it back to talking about Travelers companies, I would go as far as to say that I think this is a very solid pick for a beginner stock. Now, that's not meant as a derogatory or as an offensive term, because as a reminder, a beginner stock is a good long-term investment because it's high quality. So a beginner stock is another way of saying that it's a great stock for veterans and people that are new to the stock market alike. It is high quality. So does it surprise you that their grade is an A? And before we move on to the next company, to be completely honest, every single one of their numbers are pretty darn good, except for the dividend yield. I wish this was like a 3%, but I'll take it because the CAGR is 12.2%. But moving on, the next insurance business is Chubb Limited, ticker symbol CB. Now, this is a do-it-all insurance company, and they have a pretty big presence overseas, and they even have insurance for the super wealthy. So if you are a billionaire, you probably have insurance with Chubb in case you get kidnapped during your little vacation to Mexico. Dividend profile looks pretty similar to the Travelers companies, except the growth rate is 1% higher. The CAGR, I would argue, is pretty darn good. I think anything above 10% makes me happy. So a good CAGR performance, their tangible book value per share, $98, growing year over year. The value of this company growing year over year at 21%. And as a reminder, when you buy into an insurance stock, you're buying their books and ultimately the float that's within their books and that float to be able to grow. So to see it growing at a rate of 21%, I'm not even gonna lie, my left nipple might be perky, may or may not be perky. And as we jump on down to look at their PE ratio, 11, seems okay. Their price to book ratio of 1.7, I like it. The closer it is to the valuation of 1, I like. That means it's not too much premium priced in. And to round it out, their return on equity is 12.8%. I think there's a lot to like about Chubb Limited. So just like Travelers Insurance, I also think that Chubb is a really solid beginner stock. It gets a valuation of an A from me. All right, friends and family, the next one is gonna be Allstate Corporation, ticker symbol ALL. It's a do-it-all insurance company just like Chubb and Travelers, but it's one of the biggest players. They do every flavor of insurance and they hold about 10% of the market share for auto and property insurance, meaning 1 out of 10 people in the US do business with Allstate. And apparently, based on my research, their auto insurance has some of the best rates, and they even do pet insurance. Speaking of which, if you're contemplating whether or not you should get pet insurance for your dog, I'm going to tell you right now, you should, and it is absolutely worth it. My puppy, when he was about like a year old, he had a huge medical emergency and he almost died. It was a really scary time, and I remember the emotions. It was devastating, right? You're about to lose your little buddy. But eventually he made it through, and he's super healthy now. But what was even scarier, dude, the bill from the veterinarian, it was absolutely up here. But thank goodness we had pet insurance because it came in clutch, and I was able to walk away without it being too much of a financial burden. So pet insurance, I think it's really good. But taking a look at Allstate's numbers here, $193 a share, earnings per share, which is their net income, their bottom line broken down to a per share level, $14.64. So out of the 3 big dogs right here, they do have the lowest net income per share. Dividend yield is a little bit higher at 2%. Dividend growth rate, pretty good, 6%. Performance in the stock market at 8.6%. I would argue for an insurance stock, that's just okay. But what is not okay is their tangible book value per share growth year over year, 48%. Dude, that is diabolical. They're growing the valuation of their books and of their business by 48% year over year. That is really crazy. And remember how I said that if it's a high return on equity, it's usually a high P to B ratio, unless you find one that's a hidden gem and it's like a 1, whereas this is like a 20%. But all that to say, a 19% return on equity is the best that we have seen here so far. That is really, really good. But unfortunately for Allstate Corporation, I think what's holding them back is their stock market performance. Because between you and me, I would rather have a 16% ROE and to get a 12% CAGR than to have a 19% ROE and to get an 8.6% CAGR. So for that reason, I think ultimately Allstate is a B, a very solid B. Not a B minus, not a B plus, a very solid above average insurance stock. I think it's way better than Prudential Financial by all regards and metrics. The next insurance business is going to be Progressive Corporation, ticker symbol PGR. It's the second biggest underwriter of auto insurance in the US, and they have about 15% of that market share. So currently trading for about $251. Their net income per share is $14.83. Their dividend profile looks wonky. And I'll say this, 300% growth rate, that's not true. The reason being is that almost every single year, every 12 months, like clockwork, except like 1 year or 2 years, they pay a special dividend. And that special dividend is like $4.60. Let me just pull up Progressive's profile right here. If we jump on over to the dividend page and look at it visually, you get a normal dividend payment that doesn't grow at 10 cents every quarter, and then bam, they hit you with a special dividend. And then bam, they hit you with a special dividend. So their growth rate is a little misleading, but I went ahead and put 300% because that's what it is on paper. So with Progressive, you'll get a 10-cent dividend, and then based on how good their profitability and earnings are, they'll pay you out the rest. So it's kind of like a BDC or a REIT, except they don't have to do this, but they're willing to pay out their excess profits as dividends. $4.60 back in January of 2025. Almost every single year, it looks like they skipped 2023. If we zoom back up here, dividend growth rate, 326%, but at least now you understand why that's happening. By the way, the payout ratio is like 33%. For almost every single one of these insurance stocks, their dividend is sustainable from what I have seen. And friends and family, what is really beautiful about Progressive is their CAGR. 15.8% year over year for the past 20 years. And I think a huge part of that is that special dividend that's paid on top of your normal dividends. A 15% CAGR. That is really beautiful. I don't think you understand how beautiful that is. Your money growing 15% year over year through an insurance business? Dude, sign me up. And as we take a look at their tangible book value per share growth, it's just as good as Allstate at 48% year over year. This is really good numbers, friends. 15% CAGR, 48% book value growth year over year. Their PE is slightly higher because of the numbers that they're generating at a 15. Their PB ratio is a 5. Really high. But why is it high? Because the return on equity is also high. So remember, I was really impressed with Allstate posting 19% for their return on equity. Progressive posts 34%. 34% means for every dollar of shareholders' equity, the company generates 35 cents in profit. They're doing a really good job with the shares that are outstanding, plus with the retained earnings. Guys, I really like what I see with Progressive. So the PE ratio, the price to book ratio, and the return on equity combination tells us there's high expectations for this company, but the numbers back it up. And before you think I'm invested into this company, I am not. And as a matter of fact, I have never done business with Progressive, so I don't know how good they are with their customer service or anything. All I know is that their numbers are absolutely elite. And lucky for us, they seem to be going on a sell-off right now, which means it could be a buying opportunity. All that to say, dude, anything short of an S would be a scandal. Progressive is the prime example of what makes an absolutely beautiful insurance business. You can't tell me that you wouldn't be happy with gathering a 15% ROI on a stock year over year. Now, the next two examples will be insurance startups that are trying to disrupt the insurance space and all of the other big dogs right here with their technology and AI that they like to claim. However, let's see if their numbers look good. The first of the two will be Hippo Insurance, and they do homeowners insurance. And they're currently trading for about $27 a share, and their net income per share, their bottom line, is negative $2.11 per share. So we know right off the bat that this company is unprofitable. And to top it off, they do not pay a dividend, and their performance in the stock market, dude, I almost got angry looking at this. Negative 41%. Your money would have shrank 41% every year for the past 5 years if you invested into Hippo. And it gets worse because their tangible book value per share, is it growing year over year? Friends, family, no, it went down by negative 17%. So negative book value growth, and the return on equity is negative 12%. Everything about Hippo, I don't care how much hype or speculation or narrative or what their story is, their numbers look absolutely hideous, disgusting. Just get them away from me. I'm gonna give them their grade letter and let's move on to the next insurance startup. It is an F. And the second insurance startup is going to be Lemonade, ticker symbol LMND. It's a tech startup that does pet insurance, auto insurance, and property insurance. So a little bit more of a diversified revenue stream than Hippo. And as you can see right off the bat, they are also unprofitable. Negative $3 per share. So bad. And they also don't pay a dividend, and their performance in the stock market, negative 9.7%. So they're unprofitable, and you lose money by investing into them. But hopefully it gets better, right? It doesn't, because their book value is shrinking year over year at a rate of 26%. And dude, check this. I'm triggered right now. Their return on equity, you are not getting an ROI from investing into them. It's negative 35%. Dude, I'm triggered right now. Where's my safe space? This is so ugly. As a grade, I'm going to give them an F-. If you're even contemplating going near Lemonade or Hippo, I don't even know you and I'm trying to look out for you. This is not financial advice. They are terrible, hideous. Maybe their business is good. Maybe their customer service is good. Maybe it's a good place to work for. But as a potential investment, no bueno. No good. And just as a reminder, this is part 1 of the insurance ranking video. We have 9 more to go right here. I showed you what an average insurance business looks like in Prudential Financial. I showed you what a very excellent one looks like in Progressive. And I showed you what an ugly and a hideous and smelly insurance business looks like in Hippo and Lemonade. In part 2, when we analyze and evaluate the other 9 insurance stocks, one of them is going to be an absolute hidden gem that nobody talks about. I found it and I was like, it's like as a kid when you dig a hole and you're trying to get to the other side of the world, to, going from Virginia to China, and then halfway there you find diamond. I'm like, dude, I think I found a diamond. And then 1 out of the 9 is an absolute dividend compounder with mozzarella, Parmesan, pepper jack cheese. And I'll also be going over my personal buy price for every insurance. So if you're not subscribed to this channel, you might want to, otherwise you're gonna miss it when I upload that video. All that to say, I love you guys, stay safe, good luck in the stock market, and I'll talk to you next time. Peace.